Welcome to Insurance Operations, Risk Management and Insurance 3020. This course is based on the CPCU 520, which is Insurance Operations. It's one of 8 exams offered by the American Institute for CPCU that will get you a CPCU designation, which is one of the premier designations in insurance. I'm Dr. Christine Berry, and I'll be your instructor for this course. Most of you know me from the Principles of Insurance class. So please let me know if you have any questions throughout the class. Let's go ahead and get started with an overview, which is Chapter 1 of the text. We'll start with classifications and types of insurers. You'll find that throughout this course, some of this is review from the chapter from Principles of Risk and Insurance on insurance operations. So some of this you will have already seen. We're going to talk here about forms of ownership, the place of incorporation of an insurance company, which you probably haven't heard about, and licensing status, which is related to the place of incorporation. And lastly, marketing systems, which we actually talked about in the chapter that precedes insurance operations in Principles of Risk and Insurance. So let's first discuss the form of ownership. The 3 possibilities are proprietary ownership, cooperatives, and other insurers, such as pools and government insurers. Let's first talk about proprietary insurers. By far, the most common of these are stock insurers. A stock insurer is owned by its shareholders, and the shareholders of the stock insurer provide capital to the insurance company. They also expect a rate of return, which is given to them in the form of either dividends or because of the capital gains experienced when the company's value increases. The next 2 forms of proprietary insurers are Lloyd's of London and exchanges. Neither of these are actually technically insurers, but rather marketplaces for insurance companies. Lloyd's of London is extremely significant in the insurance world. We talked a little about Lloyd's of London in Principles of Risk and Insurance, and we'll talk about them at length in surplus lines and reinsurance. They're known primarily for insuring unique exposures. The insurers through Lloyd's of London are actually the member syndicates. The syndicates are primarily set up today through corporate investors, whereas several years ago, only individuals could be members of Lloyd's. The reason Lloyd's is so significant as an insurance organization is that it tends to be the first of any form of insurance company to insure unique exposures. Exchanges aren't terribly common anymore. Primarily, both of these exist for risks that most insurers want to avoid. These 3 types of insurers have in common that they're all for profit and they're owned by outside investors. Now let's look at cooperatives. What defines this legal form of insurance company is that the policyholders of the company are all insured by each other. In the case of a mutual company, the policyholders all are owners of the company. A mutual actually is for profit, and it is by far the most common form of cooperative ownership. A well-known example of a mutual insurer is State Farm Insurance Company. And you've heard of Liberty Mutual and several life insurance companies that have mutual at the end of their name, which are all, of course, mutual insurance companies. When the company experiences a profit, it will pay dividends back to its policyholders. Then there is the reciprocal form of ownership. A reciprocal operates much like a mutual insurance company, the main difference being that it is not for profit. Each individual member of the reciprocal, or insured, signs a contract agreeing to insure the other members. Next are RRGs. Let's look a little more closely at RRGs. These were actually established by law in 1986. RRG stands for Risk Retention Group. These were established for issues relating to reducing taxes as well as reducing premiums and for exposures that had a difficult time finding insurance. So this increased availability to these types of insureds. Risk retention groups can only be set up for liability and not property, life, or health. And last, under the cooperative form of ownership, are captives. A captive insurer is set up as part of a holding company. The captive is a subsidiary to the parent and only insures the parent company and possibly its other subsidiaries. This is done, again, for tax reasons, and so that instead of paying out premiums to a separate organization and losing the investment returns on those premiums, the captive insurer retains the risk, invests the money, and benefits from those investment dollars. Then when a loss occurs, it's essentially a form of self-insurance, paying for losses out of your own pocket. Lastly, are pools and government insurance. While pools are private insurers, both of these forms of insurance companies insure exposures that other forms of insurers are unwilling to insure. Generally, we're talking about fundamental risks. Recall from Risk Management Insurance 2005, the principles course, that fundamental risks are those risks that affect a large segment of society when a loss occurs. These are things such as catastrophes, earthquakes, hurricanes, wildfires, large-scale unemployment, and old age and retirement. And because these types of losses can be somewhat catastrophic to an insurance company, most insurance companies are unwilling to insure them. Pools and government insurance may be excess or residual insurance or reinsurance. Excess insurance would be insurance that is purchased over a lower limit of insurance purchased through the private insurance market. Residual insurance is insurance of the last resort. In other words, if an insured goes to the standard insurance market and is unable to find insurance, they can go to the residual insurance market. And of course, reinsurance is when the insurance company buys insurance to insure itself, which of course we'll talk about more in surplus lines and reinsurance. Examples of government insurance are FAIR Plans and the Citizens. FAIR plans, or fair access to insurance requirements, allow insureds, primarily those in low-income housing or catastrophically exposed areas such as the Gulf Coast, to purchase insurance through a government-sponsored plan. In the early 2000s, Louisiana changed from a FAIR plan form to the Citizens Insurance, which is modeled to a degree after the Florida Citizens Insurance. Both are government-sponsored plans for high-risk property insureds, primarily homeowners, but it also includes commercial property. Another example is the National Flood Insurance Program, which is of course administered by FEMA. Now let's look at the place of incorporation as one of the ways insurance companies are organized. An insurance company can be domestic, foreign, or alien. Let's look at an example to distinguish between these places of incorporation and what they mean. Let's assume that Jane lives in Louisiana and Arthur lives in Texas. A company called RiskBiz is an insurer that was incorporated in Louisiana and is also licensed in the state of Texas. In other words, when it set up operations, it did so in Louisiana and obtained all of its licensing through the state of Louisiana Department of Insurance. But then it also obtained a license to write business in Texas. To Jane, because Jane lives in Louisiana, the company RiskBiz is domestic, or a domestic insurer. But to Arthur, RiskBiz is foreign because Arthur lives in Texas. Even though RiskBiz is allowed to sell insurance in Texas, because Arthur doesn't live in Louisiana, where RiskBiz is domiciled, RiskBiz is a foreign insurer to him. So what about alien? An alien insurer is one that is domiciled in a country outside of the United States. So you do need to be careful when classifying an insurer. To most of us, the word foreign means outside of the United States. But in the insurance business, foreign means domiciled in a state that is not your own as an insured. When we're talking about a company domiciled outside of the United States, we have to use the term alien. In order to operate in the United States at all, in other words, in order to sell a policy to a U.S. insured, an insurer must be licensed in at least one U.S. state. So what most alien insurers do is to set up a subsidiary in a U.S. state and then operate as an alien insurer in all other states. Lloyd's of London, for example, has licenses in the states of Kentucky and Illinois. I just mentioned licensing status, so now let's discuss it further. An insurer can be domiciled, licensed/admitted, and non-admitted, which again relates to place of incorporation. So again, let's look at an example. Let's assume a company named LewisSure. This is an insurer that was incorporated in Louisiana and is also licensed in Texas, but in no other state, similar to our company RiskBiz. LewisSure is domiciled in Louisiana and operates in the standard market when it sells insurance in Louisiana. LewisSure is foreign and admitted to Texas. Again, it operates in the standard market, but not as a domiciled insurer, rather as an admitted foreign insurer. LewisSure can only operate in the non-admitted market as a foreign insurer in all other states. So just because LewisSure is not admitted to any other state doesn't mean that it can't sell insurance in other states. But if it does so, it has to do so in the non-admitted market. The only way to sell insurance in the non-admitted market, in most cases, is if an insured has already been rejected from the admitted market. And by the way, when we're talking about the non-admitted market, we're referring to the excess and surplus lines markets. The non-admitted market also includes reinsurance. Now let's discuss marketing systems. In the insurance industry, there are basically three main types of marketing systems: brokers, independent agents, direct writers, and exclusive agents or captive agents. Years ago, there was a distinction between direct writers and exclusive or captive agents, but the lines between these have blurred so much that it's not even worth making the distinction anymore. In fact, all three, brokers, independent agents, and direct writers, have become much more similar. Together, they're all known as producers in the insurance business. Today, there are other forms of marketing systems in insurance, including the internet, banks, and call centers. The internet and call centers mean purchasing the insurance directly from the insurance company. In the case of purchasing insurance through banks, the bank becomes the intermediary. Because auto insurance and term life insurance are fairly homogeneous products, in other words, the risks don't differ that much from one to the next, the internet, banks, and call centers are much more commonly used for purchasing auto and term life insurance, whereas most purchasers still want to go through a producer to purchase other forms of insurance, such as commercial property and homeowners insurance. Let's talk about how brokers, independent agents, and direct writers and exclusive agents differ. First, they vary in terms of how many carriers they can sell from. Brokers and independent agents can sell from as many insurance companies as they're appointed by, whereas direct writers and exclusive or captive agents almost always only represent one company. Examples of direct writers or exclusive and captive agent systems are State Farm, Nationwide, Allstate, Farm Bureau, Shelter, and American National. If you approach an agent from one of these companies, the products they can sell are more limited than that you could purchase from a broker or independent agent, because they can only sell products from their own company. There are some exceptions, but for the most part, you need to realize that the insurance products are limited from a direct writer and exclusive or captive agent. These types of agents tend to do very well on the personal lines and small business side, especially for small businesses that are homogeneous. They also differ in terms of who they technically represent. Technically, brokers represent policyholders, whereas independent agents and direct writers and exclusive and captive agents represent the insurance carrier. However, all of these would likely tell you that their client is the policyholder or the insured, but they would also tell you that they must develop strong and good relationships and maintain their professional status with underwriters from the carriers that they work with. They also differ in terms of the type of insured they typically represent. Brokers tend to represent the largest of insureds, large corporations and municipalities. Independent agents tend to represent medium-sized insureds and businesses, and direct writers and exclusive agents tend to represent smaller businesses and individuals and families. Now let's discuss insurer goals. Insurers basically have 5 goals. First, to earn a profit, if the organization is for profit. but even a nonprofit has to make sure that they stay competitive by keeping their costs down and their earnings up. Additionally, insurers have the goal of meeting customer needs, especially in the areas of underwriting and claims, and answering any questions that the customer might have. Additionally, insurers must diversify their risk. An insurance company, for example, can't write all of their homeowners business on the coast of Florida in Fort Lauderdale. If a hurricane hit in that one location, it could devastate that insurance company. But it's not just geographic diversification that they must achieve. As we've discussed, the insurance industry is one of the most highly regulated industries there is, so there are numerous legal requirements that they must meet, such as policy form approval and agents and claims adjusters licensing. And last, they have a responsibility to society. As you'll often hear me say, insurance companies help people and businesses when some of the worst things that could possibly happen to them happen, such as when they experience a fire, a worker injury, a death of a family member, or a lawsuit against them. Insurance companies have to be there to meet the needs of society. However, sometimes the last four goals conflict with the first. This is because each of the last four involve a cost. It can be costly to meet customer needs and to diversify risk by going to different parts of the country and ensuring different kinds of exposures. And of course, complying with legal requirements involves a cost and meeting a responsibility to society. But in the long term, if insurers don't meet the last four goals, they will not be successful because they won't be able to be competitive. One example where insurers met customer needs and fulfilled their responsibility to society, while it might have seemed that in the short term they sacrificed their profits, was after Hurricane Katrina, when many insurance companies paid claims that were probably related to flood and not wind damage. Even though flood was excluded, they would have had to litigate those claims, and it would have hurt the reputation, not just for their company, but for the insurance industry as a whole. Now let's discuss constraints on achieving insurer goals. These can be broken up into internal constraints and external. Let's look first at internal constraints. As discussed in the text, some insurers operate more efficiently than others. An insurer's lack of efficiency can relate to poor management, lack of capital, lack of information technology, and just a general inability to adapt to change. Additionally, insurance companies are limited by the level of expertise they employ. Insurance is a relatively complex business. It requires individuals who understand underwriting, insurance pricing, and claims. Both size and financial resources are related in terms of being internal constraints on achieving goals. Like any company, the larger an insurance company, the more they can take advantage of economies of scale. But for an insurance company, this is even more true, especially in the area of financial resources. If an unexpected catastrophe loss occurs, or if there's an economic downturn and the size of your investments is dramatically reduced, a larger company can generally sustain those kinds of losses more than a smaller company. But on the other hand, a small company can be more flexible and nimble and able to adapt to change more quickly. For example, if a large organization decides to employ a different technology, it may be much more complicated to install and implement that technology over thousands of employees as opposed to over just 100. External constraints include regulation, public opinion, competition, economic conditions, and marketing systems. On your own time, think about ways that each one of these areas might constrain an insurance company and keep them from achieving their goals. Now let's look at measuring insurer performance. This relates directly to insurer goals because this is a way of determining whether or not insurers are actually meeting their goals. So, what metrics are used to measure insurer performance? Primarily these. First, premiums. In other words, what is the total amount of premiums written by an insurance company? Premiums written is based on the amount of money collected for policies sold. So essentially, this is a measure of the insurance company's sales. Then investment income or loss. As we discussed in Insurance 2005, Insurance companies depend greatly on their investment income. In fact, oftentimes an insurance company will lose money on their operational income, which is the next metric. An operating profit or loss for an insurance company is how much they take in minus how much they pay out, where the majority of what they take in is their premiums, and what they pay out are their expenses, including underwriting expenses, commissions, and taxes, and losses paid to policyholders. So let's talk about what I call the big three ratios. These are the primary ratios used to measure insurer performance. These are extremely important when it comes to insurance company operations. We'll talk about the three big ratios plus one more ratio that in some ways is actually the most important of all. First, the expense ratio. There are two different bases for the expense ratio. First, the financial basis, which is underwriting expenses divided by earned premiums. Then there's the trade basis, which is underwriting expenses divided by written premium. By far, the most commonly expressed version of the expense ratio is the trade basis ratio. Let's look at the difference between earned premiums and written premiums. Let's assume a company called EdInsure writes a $12,000 premium policy on January 1st. The policy covers a school for 1 year or one policy period. If it covers the school for 1 year, that means that each month 1/12 of the policy is earned. At half a year, half of the policy would be earned, and at 12 months, the entire policy would be earned. So on this policy alone, at the end of 1 month, what has EdInsure earned? They've earned 1/12 of the $12,000 premium, or $1,000, but they've written all $12,000. So that's the difference between written and earned premium. Now let's move on to the loss ratio, and we'll do more comparisons between earned and written premium as we move forward. The loss ratio is losses plus loss adjustment expenses, where loss adjustment expenses are claims expenses, defense costs, and other costs associated with paying off a claim that are not the actual loss payment or claims payment. And this is divided by earned premium. So why is expense performance measured based on written premium and loss performance is measured based on earned premium? Let's look at an example to illustrate. Again, let's say we have $12,000 of premium and $3,600 of expenses at policy inception. At the end of 6 months, we've paid out $4,000 of loss. So calculate the loss and expense ratio using written premium on both denominators, then earned for loss ratio only. Let's do the calculations here. So for the expense ratio, we have $3,600, the total expenses, divided by 12,000, which gives us an expense ratio of 30% when divided by written premium. Now let's calculate the loss ratio. If the loss ratio was divided by written premium of 12,000, that would give us a loss ratio of 33.33%. But that loss ratio is misleading because we haven't earned all 12,000 of premium. We've only earned 6,000 of premium at 6 months. So if we take the loss ratio as losses, 4,000, divided by 6,000, which is our earned premium, or half of the 12,000 times 1/2 equals 6,000, we get 66.67%. This makes much more sense than a loss ratio of 33.33%. The expense ratio divided by 12,000 makes sense too, because we've already incurred all 3,600 of expenses at the inception of the policy. So the 3,600 is based on the total written premium, but the losses don't occur until the premium has been earned. So that's why we use written premium most of the time for the expense ratio, but earned premium for the loss ratio. Now let's look at the combined ratio. The combined ratio is simply the expense ratio plus the loss ratio. This is an extremely useful ratio because this together can tell us a lot about the profitability of underwriting. So what do these together say about the profitability of underwriting? Well, common expense ratios range between 28% and 32%. Our last example was 30%, so that was right in the range. Common loss ratios range from 65% to 75%. So if we have an expense ratio of 30% and a loss ratio of 70%, the combined ratio is 100%. So again, what does this say about profitability of underwriting? What it tells us is that we've paid out in expenses and losses the exact same amount as we've taken in premium. Now let's break it down with some numbers and look at this a little more closely. Let's assume a policy premium of $12,000 and expenses of $4,000. The end of year loss total is $8,000. So the expense ratio is $4,000 divided by $12,000, or 1/3, which is 33.33%. The end of year loss ratio is $8,000 divided by $12,000, or 2/3, so that's 66.7%. And the combined ratio is 100%, or 33.3 plus 66.7%. Again, you pay out everything you take in. And if you want to check the numbers, you see that 4,000 plus 8,000 equals 12,000, which is the policy premium. Lastly, I said that we would talk about one more ratio. The last ratio is the operating ratio. This is the combined ratio minus the investment ratio. Let's look at what the significance of the operating ratio is. If the combined ratio is 100%, as it was above, and the investment ratio is 12%, then the operating ratio is 100 minus 12%, or 88%. This 88% will tell us the overall profitability of the company. Let's look more closely. In order to calculate the profit margin, which is one of the best measures of profitability, on underwriting, you simply take 100% minus the combined ratio. So if the combined ratio is 100%, then the profit margin is actually 0. But in terms of overall profitability, you take 100% minus the operating ratio, which we said was 88%. So let's look at these numbers. So the profit margin on underwriting from above is 0, but the profit margin overall from above is 100% minus 88%, or 12%. This tells me that the insurance company, on operations and investments combined, actually has a 12% margin, or is 12% profitable. Let's look at some history from the Insurance Information Institute on some of these ratios. This shows the 9-month comparison between 2011 and 2012 combined ratios. The combined ratios for both personal lines and commercial lines improved substantially through 2012, quarter 3. Still, you'll notice on all lines that the combined ratio in 2011 was over 100% and at 100% in 2012, just at the 9-month point. Then we look at the number of years with underwriting profits by decade. Underwriting profits were common before the 1980s. 40 of the 60 years before 1980 had combined ratios below 100%, which means that the insurance company actually made money on underwriting. But those vanished. Not a single underwriting profit was recorded in the 25 years from 1979 through 2003. And also, I want you to notice the relationship between P&C impairments and combined ratios. So first, this is just the number of property and casualty impairments. In other words, the company basically went bankrupt, or nearly went bankrupt, with the highest numbers being in the early 1990s. In this chart, you see the relationship between combined ratios and PC impairment frequency. The purple line represents the PC impairments from the previous slide, and you can see a direct relationship between the combined ratio and PC impairment. So the higher the average combined ratio in general, the higher the PC impairment. Now let's look a little more closely at what causes PC impairments. Deficient loss reserves and inadequate pricing being the primary cause. Rapid growth, which we'll study throughout the semester, alleged fraud and affiliate impairment, catastrophe losses, investment problems, and significant changes in business and reinsurance failure, along with some other miscellaneous causes, are all the primary causes of PC impairment. Since deficient loss reserves / inadequate pricing are by far the most common cause of insurer impairments, in fact, it is one component of loss reserves that leads primarily to inadequate pricing and ultimately to impairments. And it is also the biggest problem of measuring insurer profitability, and that is IBNR loss reserve development. IBNR, or incurred but not reported losses, are the most difficult loss reserves to measure. IBNR reserves are reserves set aside for losses that have already happened but have not even been reported. We'll talk about this throughout the semester, but just imagine, as an example, that a home experiences a flood. The policyholders haven't even gotten back to the home to be able to report the claim. In liability, this can take an even longer time. It may take months or years for a loss to even surface after the accident. Think about liability from asbestos or pollution. IBNR reserves are basically just educated guesses about what the insurer should set aside in order to pay for future losses. They can be the biggest component of an insurer's loss reserves, and therefore, if they're not estimated properly, can dramatically overestimate an insurer's profitability, ultimately leading that insurer to be impaired. So this chart is useful because it maps the prior year loss reserve development and the impact on the combined ratio, which provides evidence of the relationship between reserves and combined ratios. And as we've already shown, combined ratios are directly associated with impairments or failure. And finally, as a way of ending this chapter and moving on into the rest of the course, let's talk about all of the different insurance functions. The core functions, according to the CPCU, are marketing, underwriting, and claims. Other functions that in some cases I would argue are also core functions for an insurance company are actuarial functions, which is of course rate making or pricing the insurance product, loss control, reinsurance, investments, information management, data analytics, premium audit, human resources, legal services, and accounting. We'll talk about all of these different areas of an insurance company's operations throughout the rest of this semester.